Hello everyone, welcome to MoneyDhan. I am your friend Sujita Sas. Recently, our stock market has reached a record high, and on one side, many investors are congratulating each other. On the other side, some investors are thinking whether they should sell and exit the market now. This is because there is a popular saying amongst investors that you should buy on rumor but sell on news. As you may have noticed, for some time the market has been waiting for election results, and many rumors were circulating in the market about the election outcome. When the results of the recent state elections were announced, it was revealed that BJP won with a majority in Madhya Pradesh, Rajasthan, and Chhattisgarh. These state election results were crucial because they gave confidence to many investors that the present government might retain power in the upcoming Lok Sabha elections. Due to this confidence, the market broke its all-time high. Now, some investors are concerned that our market is overvalued, and if the market rallies more on this election hype, the valuation will increase even further, causing a tense situation amongst investors. Since valuation always wins in the long run, smart investors are always reluctant about investing at overvaluation. In this tense situation, it is essential to pay attention to the proverb, buy on rumor but sell on news every day. There is a lot of anticipation and questioning among investors about whether there could be profit booking or a market fall. This brings an obvious question to their minds, whether they should exit the market at its all-time high, or wait, or if they have confidence for further upside, can the investor invest more? Let's see, based on events, how the market will behave, whether it will rise, fall, experience profit booking, or see increased buying. Tracking all these events is like chasing the wild goose. The point here is that today's reason could be an election, tomorrow's reason could be war, or the day after tomorrow could bring some other reason. If the present ruling government wins again, there is short-term excitement, and similarly, if a new government comes in, the fear of upcoming uncertainties is also short-term. Just because there has been a change in government, the stock market never stops. But elections definitely influence the market in the short term. Based on the results of the election, the market can either rise or fall in the short term because the elections of any country impact the political and economic context of that country. For example, policy changes, such as if a new government comes in, it brings along with it some new policies and reforms that directly or indirectly impact the market. This is because the elections of any country impact the political and economic context of that country. For example, policy changes such as if a new government comes in, it brings along new government policies, economic policies, or regulatory policies that may be unfavorable for a particular sector or businesses. On the other hand, these policies may be favorable for some other businesses and sectors, leading to fluctuations in those particular sectors or stocks. Along with this, there is also a downside that the new government may revise the past government's policies, impacting various sectors and businesses. It can discard previous policies and introduce its own policies, leading to a slowdown in growth. This phenomenon is not limited to India but occurs worldwide. For example, during the Obama administration, they supported companies which were focusing on climate-related activities. Obama administration believed in climate change. However, when the government changed and Donald Trump became president, he denied climate change and halted all spending activities related to it. This change in policies due to election results creates short-term uncertainty in the stock market. When there is uncertainty in the stock market, volatility tends to increase. Our market has also been in a state of uncertainty for some time. However, when the election results came in, It seemed that if the BJP performed well in the state elections, it could be a strong contender in the upcoming 2024 Lok Sabha elections, and the present government might continue for the next term. This belief that BJP might win again has led to market uncertainty and a rally in anticipation of it. Many investors now anticipate that the market is becoming overvalued, and when profit booking happens, the market may experience a decline. Ultimately, the market follows valuations. As discussed at the beginning of the video, tracking the market based on events will be crucial because such events will continue to occur. Today there are elections, tomorrow something else, and the day after something else. Therefore, we will track the factors influencing the market, such as when the money flows in and out of the market. Two significant factors are foreign investors' money inflow and interest rates. Starting with the first factor, foreign investors' inflow depends on several parameters. The first parameter is whether the country's GDP growth is strong. Presently, India is considered a booming economy, and according to S&P Global, it is expected to be one of the world's leading economies by 2030. Now, considering the prospects of growth, if we look at the next 10 years, India has the potential to become the world's third largest economy, with a GDP capable of growing at a rate of 7%. So, if we consider these growth prospects, Indian markets appear to be an attractive investment destination for foreign investors. This means that due to the GDP and economic growth, money is likely to stay in the Indian market and the chances of it going out are minimal. This gives us confidence that markets might not correct a lot. Let's talk about the bond yields in the US. You need to remember this. When bond yields increase, the stock market does not perform well. And when bond yields decrease, the stock market performs well. When bond yields increase, money flows out of the stock market, creating selling pressure. Whereas, when bond yields decrease or start declining, foreign investors' money comes back into the Indian stock market, thus creating buying pressure, and when buying pressure increases, the stock market also increases. So, we have understood the relationship between bond yields and stock market performance. If you want to track it with proof or understand it better, you can check the 10-year note bond yields in the US. In August, they started increasing, continued in September, peaked in October, and during these 3 months, foreign institutional investors sold heavily in the Indian stock market. After that, in November, the rate of increase in bond yields started to cool down, causing the selling by FIIs in the Indian stock market to also slow down, settling at around 5,700 crores INR. Subsequently, as the rate of bond yields started to decrease in December, FII buying in the Indian stock market began, steadily increasing until December this year. The simple reason for this is that when bond yields decrease, the money of foreign investors starts coming into the Indian stock market, creating buying pressure and positively influencing the stock market. By now, you understood how important roles does FIIs and interest rate plays in the share market. We all know that history repeats itself. And Nifty index, which is at its all-time high today and making us all nervous and confused, has been giving us hints from its own history. Did you know that since year 2013, Nifty have given only one negative calendar year? Already, Nifty started at 18,100 this year, January 2023, trading now near to 20,900 levels, 15.4% up. While Nifty keeps giving positive returns, you must consider the benchmark as well. At MoneyDhan, our research team always compares things with risk-free interest rate, also known as bank fixed deposit rates. At present, our bank fixed deposit rates are around 8%. In past 10 years, Nifty has underperformed bank fixed deposit almost 5 times. But the other years, when Nifty did well, it did so good that after 10 years, the average Nifty index return is still 14%. This is excluding present year's return of 15%. This tells you that Nifty gives good returns once every 3 years, and you should keep accumulating more and more without being bothered about all-time high. So far you realized 1. How election news affect share market in short term. How long-term share market growth depends on fund inflows and outflows. We also understood how our strong GDP and lowering interest rate is going to attract inflows, thus keeping the share market up for foreseeable future. Moving on, let us address your fear. What if market crashes now? To understand that fear, we can look back in time and draw inspiration from the worst crash in recent history. We are going to check how markets behaved during COVID, when entire global economy was shut down. Before COVID crash of year 2020, market was at all-time high in 2020 January. Suddenly the COVID crisis triggered and that caused markets to panic, which means all of us, you, me and even sophisticated fund managers panicked. Most of the investors considered it as a doomsday and exited before the world ended. But what we all forgot was that the Nifty is an algorithm in which it keeps the best top 50 companies in India. If you are invested in India's top most 50 companies, chances of your recovery is highest in comparison with other individual stocks. That is exactly what happened. As you can see, within 6 months, world realized that all is not bad. Therefore, markets shot up like a phoenix from ashes. Nifty touched its all-time high within 6 months. In hindsight, don't you think Warren Buffett's advice makes sense? Be fearful when others are greedy. Be greedy when others are fearful. Every crash prediction is not always true. Even when crash happens, it is an opportunity in disguise. If you get stuck during crash, forget the invested capital for next few months. I am sure you invested with a long-term horizon and no intention to pull that money out in next 1 or 2 years. Always remind yourself, Nifty index with its highly reliable best 50 stocks in India will be recovering soon. I hope you are convinced about the crash scenario in share market. Every crash is an opportunity. All it asks is few months of patience. As a SEBI registered investment advisory, it is our work to have a long vision about market's next move. Please do remember, whatever we share with you here are general information. This cannot be used as an advice. Without onboarding you or having your KYC done, we cannot recommend any advice to anyone. So, if you wish to use our time, knowledge and expertise to help you out in the journey of wealth creation, please visit www.moneydhan.com. When Nifty was at 10,000 levels and 10% rally was equal to 1,000 points. Now Nifty is above 20,000 levels. Here onwards, a 10% rally in Nifty should mean 2,000 points for us. So the message we are sending out here is, unless you see Nifty giving a 3,000 points rally, valuations are never too high. We all need to look at things from the perspective of percentages and not points. When it comes to valuations, FIIs concentrate their investments on finance and IT most of the time. Even after Nifty achieving an all-time high levels, banks are not valued at all, overvalued at all. You can notice that the blue highlights represent price to earnings ratio for major banks in India. This present ratio for top banks is way less than its 5-year, 7-year and 10 years price to earnings ratio. This means the stock prices are still fairly valued. Friends, people take 20 years home loan, but they rarely have the same confidence to invest 3 years income into share market. No amount of data can convince you to invest lump sum into share market. Matter of fact, we meet uncles who became rich via real estate, gold or business. But none of us actually meet anyone who got rich via share market. There is lack of social validation. However, while fixed returns from bank was 14% in year 1985, that time our parents were young. Today that FD is not above 8% and inflation is a big issue. Therefore, people our generation are forced to enter share market just to stand still and avoid being dragged back by inflation. As a SEBI registered investment advisor, our work is to provide you with the right plan and actions to be taken in share market. While you have a career to pursue and life to live, You cannot commit time to research. At such situation, people hire SEBI registered investment advisors who can fill that gap. We help you in wealth management. Remember, you have to act today to take care of your future self, so as to keep the promise you made yesterday.